All right, hi everyone. I thought I would produce a second video for you this week, just talking about the assignment that you have for this week of the course. So as you know from looking at the learning activities, you know that the primary assignment you have this week is to put together another one of those multimedia discussion board posts. But this one looking at the CAFR provided by your organization, by your city, and using that CAFR then to arrive at a conclusion about the fiscal solvency of that city. Now, I provided several videos for you looking at different types of accounting systems and walking you through how accounting works. There is one video on there that you'll probably find very useful, and that's how to read a government CAFR, a Comprehensive Annual Financial Report. Now, a note of caution about that video. That video is from an organization that oftentimes takes a very dim view of government spending and a very dim view of the public sector. And so some of the advice they give in that video may be a little pejorative to the public sector. So just keep that in mind. But I do think it's helpful because it goes through the Los Angeles CAFR and kind of shows you where you find things like the net position, the net cash position, balance of assets and liabilities. Kind of shows you how to go through a financial section of a CAFR and kind of work your way through understanding the information presented there. So I do recommend you watch that video. It is helpful. It'll give you some good tips and tricks, but just do recognize that it's coming from a certain philosophical position that is sometimes relatively negative to government and to government spending. But one of the primary things you're going to do as you go through your CAFR is you're going to be reviewing that CAFR to come to a conclusion about the fiscal solvency of your city as represented in that CAFR, compared then to what you looked at with the budget that you looked at earlier in the course. So as you determine whether or not your city is fiscally solvent, you've got some different strategies that you can use to do that. One strategy you have is to use this thing called Brown's 10-point test of fiscal solvency. And this file is provided for you in your resources for week 4. It's the fiscal solvency PDF, so it's right there for you to review. But I thought we'd walk through it, just kind of show you what Brown's 10-point test looks at. So for fiscal solvency, Brown's 10-point test looks at some indicators such as total revenues per capita. So look at the amount the government is spending divided by their population. Intergovernmental revenues divided by total revenues, to see how reliant that city is on intergovernmental grants. Because intergovernmental grants are sometimes temporary. You can't really count on them all the time. They tend to be transient. So the more you are dependent upon those intergovernmental grants, perhaps the less stable your revenue portfolio is. Property tax or own source tax revenue compared to total revenues. So this is looking at the revenue that you are generating as a city as a percentage of your overall revenue. So you'd like this to be, obviously a bigger percentage, hopefully, than the indicator above, the intergovernmental revenues indicator. Total expenditures per capita that you can then compare to your first indicator of total revenues per capita. Operating surplus or deficit divided by operating revenues. General fund balance versus general fund revenues. Enterprise funds working capital coverage percentage, which is just the current assets of the enterprise fund divided by its current liabilities. Another possible indicator you can look at is long-term debt divided by the assessed value of the government. Shows you the amount of debt you're carrying compared to your capability to basically pay off that debt as measured by your assessed valuation for property taxation. Debt service divided by operating revenues. So how much, what percentage of your revenue is going to maintain the debt that you have issued. This is something the federal government would fare very poorly on. The post-employment benefit assets divided by liability percentage. When you look at your CAFR, you'll probably see something called OPEB. That's your other post-employment benefits. So how big of a liability do you have in some of those post-employment benefits compared to the assets that you have in those funds? And so again, these are just 10 different indicators that Brown recommends you can use in order to try and assess the fiscal solvency of your city. So you can think about using some of those. You don't have to use all of them, but just an idea of some of the indicators you can use in determining fiscal solvency. Then some more indicators you might want to think about when you look at your CAFR come from Wang, Dennis, and Tu and their fiscal solvency test. So for Wang, Dennis, and Tu, they've got different indicators such as cash ratio. Cash ratio will measure your cash solvency. It's the combination of your cash equivalents plus investments divided by current liabilities. There's the quick ratio, which is cash plus cash equivalents plus investments plus receivables divided by current liabilities. Another indicator they have is current ratio, again for cash solvency, current assets versus current liabilities, a pretty straightforward and easy one. Operating ratio looks at your budget solvency, so total revenues divided by total expenses, again an easy one. Surplus per capita, the total surplus or deficit divided by population, so depending upon whether your city is in a surplus or a deficit. Some of your more long-run solvency measures are things like the net asset ratio, restricted and unrestricted net assets divided by your total assets. Long-term liability ratio, your long-term non-current liabilities divided by your total assets. Long-term liability per capita, your long-term non-current liabilities divided by population. Tax per capita, your total taxes divided by your population. Revenue per capita, total revenues divided by your population, and expenses per capita, total expenses divided by population. So again, these are just some additional indicators you can use to determine fiscal solvency. I'm not expecting you to use all of Brown's 10 points. I'm not expecting you to use all of Wang, Dennis, and Tu's solvency tests. But if you use a few of both, I think it would give you a pretty good, pretty broad idea about just how fiscally solvent your city is. I just didn't want you flying into this assignment for this week, kind of flying blind and just kind of saying, well, revenues versus expenditures, or do I have a deficit or do I have a surplus? There are some more nuanced indicators like you see from both Brown and Wang, Dennis, and Tu that you can incorporate into your analysis of fiscal solvency. So for this discussion board, you're going to assess your fiscal solvency of your city using some of these indicators. Tell us which indicators you are using to come to your conclusion about fiscal solvency. And then based upon your analysis of the CAFR and the fiscal solvency of the city as represented by the CAFR, think back to your budget and when you first looked at that budget and how fiscally solvent you thought the city was when you looked at the budget, and maybe kind of reflect upon some of the additional information that you got now the CAFR that you may not have seen in the budget. And perhaps maybe how your perspective of the fiscal solvency of your city changed once you looked at the CAFR in combination with the budget that you looked at. So hopefully some of these indicators will be helpful for you in doing that discussion board post. If you have any questions working on, feel free as always to contact me. Otherwise, hope everyone has a great week, and I look forward to reviewing your presentations. Take care.